Chapter 5: Financial Markets, Business Day Conventions, and Interest Rates. A financial market is a set of systems and infrastructure which connects various providers of capital to those seeking to raise capital. The main participants in the markets are governments, private sector businesses, collective funds, and individuals. Financial markets can be further subdivided into money markets, where short-term debt, in other words, debt with a tenor less than 1 year, is either issued or subscribed for. Bond markets, where long-term debt, more than 1 year, is issued or subscribed for. Equity markets, where ownership of companies is bought or sold. Foreign exchange, also known as FX or Forex markets, where one currency is exchanged for another at an agreed rate. Commodities markets, where raw materials or physical goods can be bought or sold at an agreed price. These physical goods can be divided up into hard and soft commodities. Soft commodities are agricultural products, whereas hard commodities are mined rather than grown. For example, metals, coal, or oil. Within equity, bond, money, FX, and commodities markets, a distinction can be made between spot or cash markets, where actual assets are bought and sold and transactions are settled immediately, or derivative markets, where financial instruments derive their value based on the performance of another asset, the underlying asset, and where transactions may be settled immediately or on some future date. Financial instruments. Financial instruments can be defined as contracts between two parties, where the contract represents an asset to one party and a liability to another party. The contracts can be traded, modified, and eventually settled or terminated. The value of each contract can fluctuate over time. Financial instruments can be distinguished by whether they are being traded for the first time, called a primary issue of the financial instrument, or whether they have been previously issued and are now subsequently being traded between parties, called a secondary market instrument. Secondary market instruments can be bought or sold without the involvement of the company that issued the instrument in the first place. Financial instruments can be issued or traded on numerous platforms. These platforms can be classified in two ways, namely, over-the-counter or OTC. Here, financial instruments are traded directly between dealers who mutually agree on price and other terms in order to make a trade. FX and money markets are OTC markets in South Africa. Commodities and derivatives may also be traded over the counter or OTC. Financial instruments traded over the counter can be specifically customized to meet the needs of both parties involved. Inherent in over-the-counter markets is credit risk, the risk of a counterparty defaulting on their obligations on a contract. For this reason, credit risk needs to be priced into OTC contracts, which may make the margins charged on OTC contracts higher than equivalent contracts traded on an exchange. Via an exchange. Here, financial instruments are standardized and traded through an intermediary called an exchange, not directly between buyer and seller. An exchange is a company that exists for the sole purpose of bringing together buyers and sellers. The exchange should always be in a position to provide a seller for each buyer, and vice versa. Thus, an exchange is referred to as being a market maker. Contracts traded on an exchange are settled daily, whereby the value of each buyer's or seller's losses or gains are settled and either credited to them or demanded from them at the end of each day. This is called marking to market. This daily settlement thus removes a significant amount of credit risk from the exchange. Bonds and equities can be traded over the counter but are mainly exchange traded in many jurisdictions worldwide. For example, the New York Stock Exchange and Nasdaq in the USA, the Bond Exchange of South Africa, or BISA in South Africa, and on the Nigerian Stock Exchange, for example. Derivatives and commodities are also mostly exchange traded, although over the counter markets of significant size also do exist. Money market funds, money market accounts, and the money market. The money market is a network of borrowers and investors, namely corporate entities, governments, or individuals, all of which have a short term borrowing or investment horizon, less than 1 year. A distinction should be made between money market funds, money market accounts, and the money market. Money market funds are set up by institutions or banks to pool the deposits of retail individuals together in order to create a larger fund. These funds then invest the proceeds in money market instruments that the individual retail investors may not be able to access by themselves. It should be noted that money market funds are prohibited from investing their funds in instruments that mature beyond 1 year. These funds are also prohibited from having a weighted average maturity greater than 90 days. A money market account is just the name of a normal bank account that is structured in such a way to incentivize the account holder to deposit large amounts of cash in their account over a long duration. The bank would use various incentives to discourage clients from withdrawing their deposits from the account. However, the client would always have the option to withdraw their funds at any time. An example of an incentive would be to offer clients higher interest rates, which would only be enjoyed if the client was to maintain a minimum account balance. Usually, money market accounts pay a significantly lower interest rate if the client's account balance falls below a minimum threshold, thus encouraging the client to constantly maintain a large deposit with a bank for extended periods of time. We will now examine the money market in great detail. The money market. The money market is an over-the-counter market, meaning that it is made up of a host of individuals that transact directly with one another without the use of an independent intermediary such as an exchange. It is facilitated by banks, and its main participants are large corporate entities, government entities, the Reserve Bank, and money market mutual funds. The main purpose of the money markets is to solve the timing problem faced by governments and large corporations with respect to revenues and expenditures. For example, governments raise tax revenue throughout a financial year. However, during certain periods in a year, they may need to make large investments and may not readily have the cash on hand to do so. In such cases, governments would need to raise short-term funding, shorter than 1 year, in order to bridge their funding needs. They would raise such funding in the money market. The government is the largest borrower in the money markets. Governments borrow money by issuing Treasury bills through the Reserve Bank. Large corporate entities also use the money markets to borrow short-term capital, however, on a much smaller scale than government entities, and they usually issue commercial paper or bankers' acceptances. Banks are another large borrowing group in the money markets. Banks borrow money in the money markets and combine these borrowings with depositors' money in order to be able to make loans to other businesses and individuals. Banks also purchase Treasury bills in order to satisfy their liquid asset reserve requirements. These are requirements that the Reserve Bank imposes on banks to make sure that they hold sufficient capital to minimize their risk of insolvency and thereby safeguard the funds of depositors. The providers of capital in the money markets are companies and investment funds, which act via banks to provide the capital to borrowers. They do so directly by buying the financial instruments issued by government and other large corporates, and indirectly by depositing their excess cash in money market funds. The Reserve Bank is both a borrower and a lender in the money market and has a mandate to regulate the supply or deficit of money in the economy, in line with its monetary policy. The Reserve Bank can either issue bonds, thereby borrowing more money and consequently decreasing the money supply in the market, or purchase securities, thereby supplying money into the market. The supply of money in the market directly impacts on the price inflation experienced in the larger economy. An important mechanism employed by the Reserve Bank in adjusting the liquidity in the money market is the repo auction, which indirectly affects all interest rates in the market. Repurchase agreements or repos will be discussed later in the course. Some important terms which will be used in the remainder of the course will be discussed here. Through the money market, participants can engage in both spot or cash trades and forward trades. Spot transactions are usually settled immediately or within 1 or 2 business days after the trade was executed. Forward trades are entered into today, with settlement occurring at some date in the future. The settlement date refers to the date upon which the funds and financial instrument actually change hands between the buyer and the seller. For forward trades, the final settlement amount paid between parties would be linked to the time value of money. Note that the settlement date of a transaction or financial instrument is not necessarily the same as the maturity date of an instrument. The maturity date refers to the date upon which the financial instrument expires and ceases to trade.